Guys, I'm the KeyTrader here, and today we are going to look at the 10 tips to become a successful Forex trader. So, a word of advice before we begin. So you should know the goal of a successful trader is to make the best trades always. So what's your goal as a trader? I know most people enter the markets to make money, but money should be secondary. It should not be the main objective. The main objective as a successful trader is to pick the best trades, the high probability trades, and you trade them only, and in the long term you'll be very profitable. So first of all, before you can trade in markets, you need capital. Like any business, you need capital. So to make consistent earning from the market without taking high risk, you need a very substantial account size. So you can start, most people, a 5-figure account, 4, 5, 6, it all depends. So to remain solvent long after the statistics of your strategy have played out, you need to have at least, if for example, let's take up here, if for example your trading strategy has a 20% win rate, and you have a $10 account, if you lose 7 trades in a row, risking $1, you'll still remain in $3 in the long term. So these 3 times, maybe you have a 1 to 3 risk reward, that will translate to $9 in profit. So you see, in the long term you're profitable. But let's say for example, with the same 2 risk reward and you're risking $2 in a $10 account, if you lose 5 trades in a row, you have blown up your account. And you see, so capital is very important. Like I had said, you need a good account size in order for your trading strategy to work itself out, to play its course, and in the long, and still to remain solvent, because as you all know, the market is very high risk. And in order to grow your account, let's say, in order to turn these $10 into $1,000, you need to take a very high, you need to increase your leverage and to take high risk in order to make any consistent earnings. So in order to make a good amount of any income, you need to at least over $10, and you can only risk 1% of that account to make a good earning in the long term. So first and foremost, if you want to be safe, to make money in this market, a sizable amount, first look for capital. So moving on, you have the 3 trading pillars of any trading strategy. So first of all, to become successful, you need to understand the technical analysis. Then after you have analyzed how to analyze the market, you look at the risk management, how to manage your risk. Then, and this is very important, your psychology as a trader. It all boils down to your psychology. So we have this trading system here. As you can see, money management is very important. If you can't manage your money, you can't be profitable in the long run. So 40% is money management, then the trading strategy, this take 30%, then psychological factors and all that, they take 30% also. So to begin off with the technical analysis. So what is technical analysis? This is how you analyze the market. This is how you read the price action, the battle between buyers and sellers in the market, and how you can translate that in the price chart. So then you should know technical analysis is not enough. You need to use other confluence, like you can use the different analysis, like the currency correlation. This is how different currencies move in relation to each other. Like if this currency is moving up, this other currency is moving down, and all that. Then you have the currency strength. This is always you buy the strongest currencies and sell the weakest currencies. Then the fundamental analysis. So fundamental analysis is where you trade the news. So the high impact news and how they move the markets, the increasing volatility in different times. So you can always read that. Then this is very important, the COT data. So this is a weekly report that comes out on every Friday, and it is how the big banks, institutions, and hedge funds are positioned in the market. It's very important to see the overall direction and how these big players are moving the market. Then you should also be able to understand how different markets move. Different markets and pairs have different psychology, have different personalities. So you should learn how they behave, and you'll be profitable. So risk management, as I had said before, the only thing you can manage and control in this business is your risk. So and what risk, your risk will be a percentage of your account that you are willing to lose. If you're not comfortable with the risk, I can't stress this is enough, don't take the trade. So you should be psychologically, you should be comfortable with that risk. And a good risk, a stop loss should be placed in a logical place, and it should always be protected by market structure. And if the trade is moving in profit, you can always move the stop loss to break even. So this will help you relieve the psychology, and you'll be risk free. So it will help with the psychology. So risk management is very important. If you can't manage your risk, let's say for example, let's take a pen here. Let's say for example you have $100 account. You're taking 10% risk. You're taking 10% risk per trade. So that's $10 per trade. It will take you 10 trades to 10 consistent losses to blow your account. But let's say for example you don't have a risk management. One trade you take it with a $10 stop loss, then the other trade you get overconfident and you take a $10 and $20 stop loss. So if you continue doing this, it will only take one trade or two to blow up your account when your losses are, and your losses will continue to pile up. So always be able to manage your risk. If you can't manage your risk, it will be. So the psychology. So when you're talking about psychology, this is your attitudes and beliefs about the market. So the different psychological pitfalls and cognitive bias. So as a trader, you should be disciplined first of all. If you don't have the discipline, you won't have a good risk management and you won't be able to follow your trading strategy. So let's, for example, hyperbolic discounting. This is one of the psychological pitfalls. So this is where instead of letting a trade run, you have set a stop, you take profit and a stop loss, but instead of letting the trade run, you let that you exit the trade earlier with a small profit instead of letting the trade run. And most of the time you'll exit the trade and you'll see the trade goes to take profit, and this will impact your psychology as well. So and you'll do something called revenge trading and all that, and that's not good in the long run. In the long run it will impact you, and you'll start acting irrationally in the market, and that's will become the downfall. So the emotions, so the different emotions that drive the market and plague the traders, like the greed, fear, and all that. So on the greed, you should know bears and bulls make money in the market and pigs get slaughtered. So always remember that. Don't be a pig in these markets. So patience. So as you all know, you should not always be in a trade. Trading is 10% buying and 10% selling, and the 80% is waiting. You should always be waiting for that high probability trade to come along. Your trading setup to form and the market to show its hand before you enter any trade. Don't always be willing to jump on a trade. If you enter a trade in an overbought condition, don't always enter in every overbought condition. Always wait. So fear. Even though you should always have a healthy fear of the markets, but there are also these are the four primary trading fears, like the fear of being wrong, fear of losing money, fear of missing out, and leaving money on the table. So these are the four that drive people. If you have the fear of being wrong, even if there's high probability trading setup, you won't take it because you have fear of being wrong. And if you enter that trade and you see if it goes into profit, you see it is chopping around your stop loss, around your, and in a small loss, maybe you'll fear losing money, and you'll exit the trade on a small loss, and you'll see it goes to the take profit. So that's another fear. Then you see a trade that you're waiting for and it's going, and you fear that you're missing out and you jump on it when it is too late. That's another fear. And the fear of losing money, of leaving money on the table. This is where greed again comes in. The trade is in good profits, it's almost taking your profit, but you move your take profit and you continue moving it, hoping for more gains. So this will impact your trading in the long term. So At any time, you should always ask me before enter trade why you're entering. Are these any four fears impacting your trade in any way? So your trading strategy. So before you can trade in markets, you need to have your trading strategy. What do I mean by your trading strategy? So trading strategies will have the rules of direction buyers. So the major players are watching the daily, weekly, and monthly time frames, and these time frames always, this is the bigger picture, and they always win over their short time trades of the short time trading time frames. Then you should have the rules for after you have decided on the direction of where the market is going. Then you should move to the daily time frames, the 4 hour, the intraday time frames for your entry, to pinpoint your entry. So you should always have the rules for entry. So and once you have entered the trade, you should know how to manage that trade, when to move your stop loss to break even, when to take your first take profit and all that, and how to trail your stop loss. So that's very key. And another advice here: a good system is a system that does not just provide winning trades every time, but over time. So what's the goal of the trader? In order to make money in this market, you need to be profitable consistently, and the good trading strategies should do that, should see to it that you are making money over time. Of course you'll have losing trades, but in the long term you'll still be making profits. Look, trading is a game of probability, so you'll always have losing streak and a good trading strategy. Even the best traders out there, the best they can do is 60% win rate. So always remember that. So another word of advice on the same: it is consistency that makes a great trader. Hence, you should cultivate trading habits and daily routines that are repeated day in, day out. And that's how you cultivate a good trading culture and habits that will help you to become consistent in this trading business. So 6, beware of market manipulations. So at different times and on different markets, and every market, these big players that I mentioned on the COT data, they manipulate the market different. They are called the smart money. And at different times, because they have a lot of money, but there's no liquidity in the market for to fill in their big positions. So what do? They hunt the stop loss of the retail traders. So when they had this stop loss, they're looking for liquidity. Let's say, for example, you have a sell here and a stop loss here. So if this market they want to take the market, they'll go to look there, because they want to sell the market, but everyone is selling too. So the retail are all selling. So in order to get the liquidity in order for them to sell, they have to be buying. So what will they do? They will spike here into this stop loss, and when a sell stop loss is spiked, these people have to buy back their position. So there's a lot, hence a lot of buying liquidity, and hence they sell, and the markets move. So always be aware of this, and a good trader should be aware of this and spot this manipulation at different times and trade them. So the beauty of risk to reward ratio. So as a good trader, to have an edge in the market, you should always have at least a 1 to 3 risk to reward ratio. This means you can lose 7 trades out of 10 and still be profitable. So let's say, for example, the same example I said before, you have a $100 account. You are risking $10 per trade. So this means for every trade you take, if it is a win, you make $30. So let's say you lose 7 trades in a row, so that's $70 loss. But if you win the other 3, that's $90 in profits. So that's a 20% gain in profits. So that's your edge, and when you should always be working on your edge. And if you don't work on your edge, someone else is. So always be aware of that. Indicators. So If you've been trading for some time now, you know there's no magic indicator. All indicators lag, but you should use them to add to confidence as a trader. You should always learn through the price action. So what are the markets? The markets are nothing but me, you, and other traders trading each other, the emotions and all that. So the price action is the best. So always, but you can always use these indicators to add to as a confidence to your trade. So but you should always have at least 1 to 2 maximum, or 3, but not more than that. If your trading chart looks something like this or worse, you are lost as a trader, because you can't see the price action, and the price action is everything in the market. So don't fall for this thing. If your trade looks like this, you need to make the charts naked and all that. So price action, yeah, this is very important. So what's the price action? It's the only leading indicator, and it is a battle between buyers and sellers. The order flow, understand how and you should always understand how different patterns and the different price patterns and the price phases, the consolidation where the big banks are accumulating the position, and when you understand this and the different phases, then the multi-time frame analysis. This way I use different time frames to add to your edge. You should always be working on your edge as a trader. So you use the daily, weekly, and monthly for direction bias. Then use the intraday time frames for entry. Then yes, and you should always remember higher time frames always overweigh low time frame picture. So the big time trend will always overrule the short term. And after that, you should have the good trading location. So a good trade location will help with the risk to reward ratio, and with a good analysis you'll have a very small stop loss and a very big take profit. So when you continue on that, you should know what type of trader are you. It all comes back to your psychology and your risk appetite. So are you a scalper? This is for short-term gains, then the day trader and the swing trader. So but you should not be boxed in one category. You should always react to the different market conditions, and if the market is presenting opportunity to scalp the market. If this is a swing trading opportunity, swing. So don't be boxed in one category. Always adapt to what the market is telling you. And as you all know, market is a game of reacting, not predicting. You can never predict where the price will go, but you can always react to it and capitalize on it. So the 10th tip and the last one is keep it simple. Don't try and reinvent the wheel. Take only the simplest setups, and only when the market shows its hand. Don't always be the first one to jump on any trade. Always wait for confirmation, and this comes back to your patience, which we talked before. So wait, patience, and keep it simple. Don't try to complicate things. If you try to complicate things, you'll be lost. So keep it simple. So as I said before, I have this table here and how all these things play out: the capital, the method, and your personality, which is also the psychology. So as you can see here, you can't have one. In order to have results in the long term, you need to have all of them. So if you have capital and you don't have the method or the personality, you'll lose. You'll have all the money, but you'll blow up your account. If you don't have the capital but you have the method and you don't have the personality, you won't be able to do anything. But if you don't have the capital or the method but you have the psychology, you still won't be able to do anything. You have the method and the capital, but you don't have the personality. This will mean you'll over risk your trade and all that, and in the long term you'll blow up your account. If you have the method and the personality but you don't have the capital, you won't do anything. It will be a very slow process and it won't be good. If you have the capital and the personality but you don't have the method, you are also lost, because you don't know how to react to different market condition and all that. So but if you have the capital, the method, and the personality, this means you have everything and you'll be very profitable. So thanks for watching. God bless. I hope you subscribe to my channel, like the video, comment, and I'll see you later.